Hi everyone, welcome to Edupedia World. I am C. Radhika Singhal. So in the last class we were discussing that how to compute the risk, that is standard deviation, and when there are more than one security, how to compute the correlation and covariance between the two. Studying these technical computations helps the investor to select that which securities to be selected. So for an investor, there are n number of securities are available. So when an investor wants to develop his or her own portfolio, there are various factors that he or she takes into consideration. So there's one approach which is matrix approach to portfolio management, which gives three consideration to select that which securities to be considered. These three are that the investor likes to maximize its return, minimize the risk, and maximize the liquidity from a portfolio. So whatever securities are available, the investor give 100 basis point to every security, whatever the acceptable securities are. Now if a security is giving a higher return than the expected return of the investor, that security is given a point more than 100. Likewise, if a security is giving a risk less than the expected risk of the investor, that security is also rated higher than 100 basis points. And also, security is easily convertible into cash than the expectation of the investor, then it is also rated higher than 100. After computing all these securities or taking these three factors into consideration, the investor select that which security is to be included in his portfolio. This is the matrix approach to portfolio management. The next model, which is used to analyze the risk return options in a portfolio, is Markowitz model. This is very famous model. Markowitz is also known as father of modern portfolio theory. This model was developed by Harry M. Markowitz, and this model it provides a framework for analysis of the risk and return options to strive that which portfolio helps the investor to achieve maximization of its return. So for in Markowitz model, there are three criteria basis which a security is selected and included in a portfolio. An investor will only invest in those securities which provide at higher rate of return at a same level of risk. A higher return or a higher risk will only be accepted if that security is providing high return. That means at a same level of risk, all the securities which are providing a return higher than the expected return are selected, and a higher risk is only acceptable when securities are providing higher return than the same level of risk. And at the same level of expected return, if there is any security which is providing a lower expected risk, then that security is also included in the portfolio. I'll just show that an example to understand this concept better. Let's say there are securities from A to J. The expected return from A is 15, from B 13%, C 10, D 8, E 5, F 5, 10, 10, 7. Security A, for expected return of 15%, there is a risk of 13%. In B, there is a risk of 8%. C, 10%, but with a risk of 4%. So you see that security C, security G, and security H all are providing an expected return of 10%. But at the same level of return, the risk is 4% for security C, 12% for security G, and 9% for security H. As per Markowitz work, at the same level of expected return, a lower risk will be acceptable. So any security which is providing a return higher than 10% and a 10% return with a risk of less than 4%. So securities earning more than 10% are security A and B. So security A and B will be selected. We have chose C because at 10% it is giving the minimum risk as compared to G and H. So security C is selected. So the other two securities A and B, since they are giving more return than 10%, and any security which has a risk of less than 4% is also selected. So security D is giving 3% risk but an expected return of 8%. So a lower risk security is also acceptable. In all the given securities, as per the Markowitz model, A, B, C, D, 4 securities will be included in the portfolio of an investor. So by comparing the expected rate and return and the risk, the securities are selected and included in the portfolio as per Markowitz model. Now, if I plot these securities on a graph, they somehow look like this. and this is called as efficient frontier, where the x-axis is measuring the risk and the y-axis is the expected return. The securities A to G are plotted, and graphical representation is called as efficient frontier. The securities which are to be selected are on the upper side of the frontier. So the big arc represents the securities A, B, C and D, and the other securities, that is from E to J, are the small arcs beyond this efficient frontier. This A to D selecting security is called as efficient frontier. The other method for choosing that which security is to be chosen basis the risk return analysis is again the CAPM model. We have already studied this model, so we are not going to spend much time over it again. Just brush up the thoughts that what we studied in CAPM model. CAPM model was developed by William Sharpe, John Mawson and John Linter. And William Sharpe also got a Nobel Prize for developing this model. This model, it predicts the relationship between the risk and the expected return of risky assets. This model is based on a concept that an investor expects a return more than the risk-free return for compensating the risk taking, whatever risk he is taking. For that, he is expecting more return. So every security has a distinct degree of risk. Higher the risk, higher the expectation of the return. That is followed by CAPM technique. So in this CAPM technique, the amount of risk premium depends upon the riskiness of the security. And in this CAPM technique, we classify the risk into two types. One is systematic and the other one is unsystematic risk. Systematic, which is for the whole of the nation, and unsystematic, which is for a particular industry, for a particular company. So the systematic risk is computed using beta, and unsystematic risk is something, a controllable risk, like if there's a strike in any company. That's an unsystematic risk. However, inflation, interest rate, all these are covered under systematic risk. In CAPM model, the expectation of equity shareholder is computed by adding up the risk-free return and adding up the riskiness multiplied by the risk premium. So whatever expected return is there, less the risk-free return, is multiplied with the beta. This is the additional expectation for taking risk. So the market risk premium, you can say, is the difference between the market rate and the risk-free rate of return. And computation of CAPM is KE is equals to RF, which is risk-free return, plus beta, multiplied by expected rate of return minus risk-free return, which is called as market risk premium. So you can say that CAPM bifurcates the cost of equity into two components. The risk-free return component, which is RF, and an additional risk for investing in particular share. The beta is computed as this product of standard deviation of that particular asset multiplied by correlation of that capital asset with market divided by standard deviation. Now we have already learned that how to compute the standard deviation and the correlation. Before that, now when this CAPM is represented into a graphical way, that is called as security market. So the graphical representation of CAPM equation is called as security market. In this, the beta is taken on x-axis and the required rate of return is taken on y-axis. When the expected return and risk is plotted, the expected return called as security market line. Let's do an example in which we are going to compute the beta and then the expected return using CAPM model, right? Dhanpat, an investor, seeking the price to pay for whose standard deviation is 5%. The correlation coefficient for a security with the market is 0.75 and the market standard deviation is 4%. So based on this information, we can compute the beta, which is standard deviation of asset multiplied by correlation divided by standard deviation of market, right? The return from risk-free securities is 6% and from the market portfolio is 11%. Dhanpat knows that only by calculating the required rate of return he can determine the price to pay for the security. What is the required rate of return on the security? So beta is 0.9375, right, which is 0.05 multiplied by the correlation, which is 0.75, divided by the standard deviation of market, which is 0.04. And in order to compute the required rate of return, KE is equals to, which is the expected rate of return. So that's why I have written as ERM is equals to 6 plus beta 0.9375 into market risk premium, which is 10.6875%. Now using this information, we can compute the equilibrium price. Equilibrium price is nothing but the intrinsic value of a share. An investor compared this intrinsic value with the actual market price, and if the actual market price is more than the intrinsic value, we say that the the share is overpriced, and vice versa, if this equilibrium price is, that is the intrinsic value of a share, is more than the market price of the share, we say that the price is underpriced and we used to buy such share. To compute equilibrium price, we first compute the expectation of equity shareholder using Kappa model. Using that expectation, we compute the price of the share, which is the intrinsic value, using the Gordon growth model. We started all these things using in cost of capital. So if that AP is more than actual price, we say that share is underpriced. So when the share is underpriced, you can buy that share, and equals to, like, when it is less than actual price, it should not be purchased, but we can sold that equity, or we can say we can sold that equity share. And if it is equal to the actual price, then we say that the share is correctly priced. The next concept is capital market line. So this is a concept of modern portfolio theory only. So this is the same as, so modern portfolio theory is the Markowitz model. So this theory also, or capital market line, it represents a linear relationship of risk and return. Security market line is for a particular asset. When the investor is actually evaluating that which portfolio is best for him, he compare the same with the capital market line. So security market line is for a single security, but capital market line is when a portfolio is coming. So CML applies to a portfolio and not to a single security. To draw a capital market, it is drawn adding up the risk return with standard deviation of portfolio divided by the standard deviation of market, multiply by the market. So in SML, draw an SML, we multiply that standard deviation of asset with the correlation of market and asset. But in CML, we take only the standard deviation of the portfolio. So when this capital market line is tangent to the efficient front fare, the point where it is tangent is called as optimal portfolio of the risk and return. So the investor indifference curve will also be the tangent to this level. At this level, the investor will be indifferent. To explain it, the x-axis is the risk, the y-axis is the expected return. So we have drawn the efficient frontier basis the analysis of the risk and return from different securities. Now where this capital market line is tangent, it's just touching the efficient frontier, that point is called as optimal portfolio. So the efficient frontier represents all the securities which are available for the investor to be chosen. And where this efficient frontier is tangent, that gives an optimal portfolio where the investor is indifferent. So there's a difference between an efficient portfolio and optimal one. Optimal portfolio is, you can say, is a subset selection of the efficient portfolios. Efficient portfolio is the one where the investor is getting the maximum return at a minimum level of risk. And the optimal portfolio is the one which suits the requirement of an individual investor. So in the efficient portfolio is representing all the combinations which is being represented by the capital market line. So CML represents all those portfolios which are efficient, and where the CML is tangent to the efficient frontier, that is the optimal portfolio. So you can say optimal portfolio is a subset selection from these combination of an individual according to his risk and return expectations. The another method to evaluate different portfolios is called as performance index. So performance index is a relationship between the expected return of portfolio and the minimum required rate of return. So here the KE is computed as per the Kappa model. So whatever expected return are there from different portfolio, that is divided with the KE. Higher the performance index, the better it is. Another is Sharpe Index. Sharpe Index was developed by William Sharpe. Sharpe Index is actually the relationship between the return of a particular security with that type of indexes. So index like Nifty, Sensex. Sharpe Index is used to reflect that how the prices of a share get influenced by market index. So if the market index goes up, what is the effect on the prices of a share? And this can be used to estimate the return on the securities. So you can say that this is a simplified version of Markowitz model. To compute this Sharpe Index is represented. Next index which is used to evaluate between securities is Sharpe Index. Sharpe Index was developed by William Sharpe. Sharpe Index is used to know the relationship between the index and that of a security. So this is used to compute that how much the price of a share get influenced by market index, and this can be used to estimate the return on securities. Sharpe index is computed as alpha L plus beta L plus E, where represents alpha coefficient, beta represents beta coefficient, and L is the expected return on securities. Now, what is alpha? Alpha coefficient refers to the value of y in an equation. You know the risk, so when x is 0, what is the y? And beta coefficient, it is a slope of regression line and is measured the changes in the value of a security related to the changes in the value of an index. Let's say beta is plus 1. So for a 10% change in index value, it would result in 10% change in the same direction in the security value. And if a beta is 0.5, it means that a 10% change in index value would result in 5% change in the security value. And a beta of 1 means that a return on a security are inversely related. Plus 1 represents in the same relation, plus minus 1 that they are inversely related. So beta is a simplified version of Markowitz model, and it is also known as single index model. Next we are going Gilt Edge primary security. Well, these type of securities are issued by such type of securities are issued in order to maintain the funds with the government. So whatever the price, the quantum and other terms are there, they all are defined by the RBI. This is one of the theoretical question which is covered in your previous year examination. Portfolio management. In the next session, we are going to start with derivatives. In case of any questions, just let me know. Thank you and have a nice day. Keep smiling.